Ever wonder what truly protects your money and, well, your personal data when you engage with financial services?
It's something we do almost every day, isn't it?
Exactly. Whether you're opening a simple bank account, maybe planning for retirement with a pension, or securing your home with an insurance policy,
Mhm.
behind every single transaction, every piece of financial advice you receive, there's this intricate, often unseen layer of complex rules.
Mm-hmm.
And these rules are designed with really one primary goal:
Mm-hmm.
to protect you, the consumer.
Yeah.
So today we're embarking on a deep dive into this fascinating, but let's be honest, often opaque world of financial regulation. Specifically, we're focusing on the other regulations affecting the advice process.
And what's really compelling about these regulations, I think, is that while they might initially seem like, dense technical
Yeah,
jargon,
they can look intimidating.
they can, absolutely. But their essence is actually profoundly simple. They are, at their core, about building and safeguarding trust.
Trust. That's the key word.
It really is. They establish the foundational standards that allow you to feel confident in a system that governs your most sensitive financial information and your long-term security. So our mission today is to sort of pull back the curtain on these seemingly abstract rules, connect them directly to your everyday financial life, and show you precisely how they impact your well-being. We'll be drawing insights from a pretty comprehensive financial education manual, which is packed with crucial details on UK GDPR, pension oversight, critical financial instruments directives, and insurance regulations.
Right. And our goal is to dissect these dense topics, extract those vital nuggets of knowledge, and present them in a way that is both engaging and hopefully exceptionally clear.
Let's give it a shot.
So let's begin our journey by focusing on something intensely personal and increasingly valuable: your data. Specifically, your rights under the UK GDPR.
Yeah, and it's almost astounding how frequently we provide personal data without maybe fully grasping its vast implications.
If it's like accept it.
Exactly. Take a moment to think about it. Every time you apply for a job, make an online purchase, even sign up for a new mobile phone contract, you are sharing deeply personal information. This isn't just administrative detail. In our digital age, this data is an incredibly potent form of currency, especially, unfortunately, in the hands of fraudsters.
That's a really powerful way to put it. Your personal data is, in essence, a digital currency. And if it's not meticulously protected, the potential cost to you can be immense.
Absolutely devastating.
Identity theft isn't just some distant headline or something that happens to other people. It's a very real, tangible threat. Our sources really highlight that if this personal information isn't handled appropriately, stored with the utmost security by a financial services institution, it doesn't merely constitute a privacy breach.
No, it goes way beyond that.
It directly exposes you to the very real risk of becoming a victim of identity theft, devastating financial crime, and even potentially reputational damage. And this proactive prevention of fraud and financial crime is actually a primary objective for regulators like the Financial Conduct Authority, the FCA, which really underscores just how critical data protection has become.
It really does. And to truly grasp this idea of data as currency, just imagine how a determined fraudster might meticulously piece together seemingly innocuous details.
Like what? Little things.
Yeah, tiny things sometimes. Perhaps a publicly available address from, say, company's house, maybe information from a past data leak that you weren't even aware affected you, or even seemingly minor details from loyalty card signups. What's your birthday? What's your pet's name?
Things you don't think twice about.
Precisely. Individually, these are just small digital breadcrumbs. But when combined, they become incredibly potent. They can be enough for someone to open credit accounts in your name, take out loans, order goods, or even hijack your existing bank or investment accounts.
Wow.
And this isn't solely about those massive headline-grabbing data breaches, though obviously those are catastrophic. It's also about the everyday digital trail we leave behind that becomes essentially a goldmine in the wrong hands. And this is precisely why regulators like the FCA place such a high priority on fraud prevention, because your data is directly linked to your financial security and your personal integrity.
That makes the stakes incredibly clear.
Yeah.
So, okay, given the sheer volume of data we share and these very real risks involved, how did the rules governing this protection actually come to be? Can you walk us through that crucial evolution from maybe the early EU directives to what we now know as UK GDPR?
Yeah, that's a fantastic question because understanding the journey really explains why the current framework is so robust, or at least aims to be. The initial European data protection legislation was the EU Data Protection Directive of 1995.
Okay, 95. That feels like a long time ago in digital terms.
It is ancient history almost. It was significant for its time, definitely, but the digital landscape was just evolving at an unprecedented pace. The rise of the internet, e-commerce taking off, vast global data transfers happening constantly.
Things they couldn't have predicted.
Exactly. It meant that a more comprehensive, unified, and crucially directly applicable framework was desperately needed. This ultimately led to the General Data Protection Regulation, or GDPR, which came into full effect across the European Union in May 2018.
Right, I remember the lead up to that. Lots of emails about privacy policy.
It's absolutely a deluge. And then, post-Brexit, the UK government made a conscious decision to meticulously retain these provisions, incorporating them directly into national law as UK GDPR. So while the political landscape shifted, the core principles and protections for your data remained firmly in place within the UK.
So continuity was key there.
Definitely. It was a deliberate choice to maintain high standards of data security and also, practically, to ensure smooth data flows could continue with the EU, which is obviously vital for business.
And it's important, I think, to understand what personal data actually means under these rules, because it's probably much broader than many people assume.
It really is. It's defined as any information relating to an individual who can be identified either directly or indirectly.
So not just your name.
Oh no, far beyond that. It isn't just obvious identifiers like your name or your national insurance number. It also includes things like your specific location data from your phone, perhaps, online identifiers like IP addresses, or even factors that might identify you when combined with other information, the so-called mosaic effect.
Interesting.
And crucially, it applies to both automated personal data, what's collected online, databases, etc., and even manual records containing personal data. Think files in a physical cabinet if they're structured in a certain way.
Right.
This broad definition truly reflects how extensively technology and information collection methods now permeate pretty much every aspect of our lives.
That makes sense. And then there are these special categories, too.
Yes, exactly. These are known as special categories of personal data, and they're treated with an even higher degree of caution and protection. Often they require your explicit consent for processing.
And what sort of data falls into that?
Well, these categories delve into deeply personal attributes. Things like your racial or ethnic origin, your political opinions, religious or philosophical beliefs, trade union membership.
Okay.
Genetic data, biometric data used for unique identification, like fingerprints or facial recognition, data concerning health, and data concerning your sex life or sexual orientation.
So really sensitive stuff.
Extremely sensitive. The regulations recognize the immense sensitivity and the potential for discrimination or harm if such information is mishandled. Consequently, they demand a significantly higher standard of care and justification for their collection and use. It really emphasizes individual autonomy over these most private aspects of life.
Okay, so all these definitions lay the groundwork. But what are the actual pillars, the sort of bedrock principles that govern how our data must be handled under UK GDPR? Because these are the real game changers, aren't they?
Absolutely. These aren't just, legal niceties buried in the terms and conditions. They are the fundamental commitments organizations make to you regarding your data. The first principle is absolutely core. Personal data must be processed lawfully, fairly, and in a transparent manner.
Right. Lawful, fair, transparent. What does that mean in practice?
Well, lawfully means there must be a proper legal basis for collecting your data in the first place. Fairly means they shouldn't mislead you about how it's used. And transparently means you must be clearly informed about what data is collected, why it's collected, and how it will be used, all in plain, understandable language. No hidden clauses, no surprises.
Okay, that makes sense. Principle 1. What's next?
Principle 2 ensures that data is collected only for specified, explicit, and legitimate purposes. And crucially, it cannot be further processed in a manner that's incompatible with those original purposes.
So that tackles the problem of scope creep.
Precisely. Where companies might collect data for one reason, say processing an order, and then later decide to use it for something entirely different, like detailed marketing profiling, perhaps without your knowledge or clear consent. This principle prevents that kind of unexpected use of your information.
Got it. Principle 3.
Principle 3 is data minimization. This means that data must be adequate, relevant, and strictly limited to what is necessary for the purposes for which it is processed.
So they can't just hoover up everything.
No, exactly. This prevents companies from collecting vast amounts of data just because they can. They have to justify every piece of information they hold about you based on the stated purpose.
Okay. And principle 4.
Principle 4 focuses on accuracy. Your data must be accurate and, where necessary, kept up to date. Any inaccurate personal data must be rectified without delay.
And that's incredibly important, I imagine, for things like credit scores or loan applications.
Hugely important. Preventing errors from causing significant issues in your financial life is key.
Right. What about principle 5?
Principle 5 dictates that data should be kept in a form that permits the identification of data subjects for no longer than is necessary for the purposes for which the personal data are processed, the storage limitation principle.
So they can't just keep it forever.
Generally, no. While archiving is permitted in certain very specific circumstances for public interests, scientific, or historical research purposes, with safeguards the general rule is clear. Data shouldn't be held indefinitely. Once the purpose for collection is fulfilled, the data should be securely deleted or anonymized.
Okay. Makes sense. And the final one, principle 6.
And finally, principle 6 is absolutely paramount: security. Personal data must be processed in a manner that ensures appropriate security, protected against unauthorized or unlawful processing, accidental loss, destruction, or damage. The integrity and confidentiality principle.
And how do they ensure that?
Well, this requires organizations to implement both appropriate technical measures, think encryption, firewalls, secure access controls, and robust organizational measures.
Organizational, like what?
Things like comprehensive staff training on data handling, clear data access policies, regular security audits, incident response plans. It's a dual-pronged approach to ensure your data is genuinely safeguarded throughout its entire life cycle, from the moment they get it to the moment they securely dispose of it.
Okay. Those 6 principles seem really comprehensive. So given all that, it's probably helpful to understand the key players within this whole data ecosystem and who is ultimately accountable for what.
Absolutely. And when we connect this to the bigger picture, understanding these distinct roles is crucial for clarifying accountability and knowing where your rights truly lie. It helps you figure out who to talk to if there's an issue.
Right.
So first, the data subject. That's simple.
Yeah.
It's you. The identified or identifiable natural person whose personal data is being processed.
Okay, that's me.
Then there's personal data itself, which, as we've discussed, is any information that directly or indirectly identifies you, broader than you might think. And the special categories of personal data, those are those particularly sensitive details like health or biometric data that demand explicit consent and heightened protection due to their inherent sensitivity.
Got it.
And then there's the term processing. You mentioned this earlier, and it's incredibly broad. It encompasses literally every action a company takes with your data.
So not just storing it.
Oh, no, much more than that. It's not just passively holding it in a digital vault. It's when they collect it from your online form, store it on their servers, analyze it to understand your habits, perhaps share it with a third-party service provider like a marketing company, or even delete it when it's no longer needed. Every single one of those steps, from creation right through to destruction, falls under processing.
Wow.
And each step has to adhere to those 6 GDPR principles we just talked about.
Right. Which leads us to the controller and processor distinction.
Exactly. This is a critical distinction. The data controller is the legal person or organization, maybe a bank, your employer, a government agency that determines the purposes and the means of processing personal data. They're the ones who decide why and how your data will be used.
They're in charge.
They are. They bear the primary responsibility for ensuring compliance with all data protection requirements. Think of a bank deciding to collect your financial history to assess a loan application. The bank is the data controller.
Okay. And the processor.
The data processor, on the other hand, is the person or organization that processes personal data on behalf of the data controller.
Like a supplier.
Precisely. For example, that same bank, the controller, might hire a cloud storage provider, the processor, to securely store their customer data. Or maybe a payroll company to process employee salaries.
I see.
Now, while the processor has its own duties under GDPR, like ensuring security and only acting on the controller's instructions, the data controller ultimately bears the responsibility for ensuring your data is handled correctly, even if they outsource parts of the process.
So the buck stops with the controller.
In large part, yes. This clarifies a clear chain of accountability, which is vital for enforcement and for you knowing who is ultimately responsible for your data.
Okay, so understanding these roles and principles, it really sounds like individuals have far more power than they might realize. Can you walk us through some of the most significant rights we as data subjects possess under UK GDPR? For instance, what exactly is a subject access request, and how can that empower someone listening?
You're absolutely right. These rights are designed to put control back into your hands. It's a fundamental shift. One of the most fundamental rights is the right to access your personal data. This is often exercised through what's known as a Subject Access Request, or SAR.
SAR, okay.
This is your legal right to ask an organization, do you hold my personal data? And if they do, you have the right to receive a copy of that data, along with supplementary information like why they are processing it, who they share it with, how long they plan to keep it, and the source of the data if they didn't get it directly from you.
So you can see everything they have on you.
Essentially, yes. It's incredibly empowering to see exactly what information a company has gathered about you. You also have the right to correct inaccurate personal data. If you find something wrong in their records, you can demand they fix it, ensuring records about you are precise and up to date. This helps prevent potential issues arising from false information, like being denied credit unfairly.
That's vital. What else? Is there a right to deletion?
Yes, absolutely. Beyond correction, you have the powerful right to have your personal data erased in certain circumstances. This is famously known as the right to be forgotten.
The right to be forgotten. When does that apply?
It applies, for example, if the data is no longer necessary for the purpose for which it was originally collected, or if you withdraw your consent, where consent was the legal basis, and there's no other overriding legal ground for the processing. Imagine you signed up for an online service, used it for a while, then closed your account. You could potentially invoke this right to have your associated data deleted.
But there are limits.
Yes, it's not an absolute right. There are limitations, particularly if the data is required for things like complying with a legal obligation, establishing or defending legal claims, or for certain public interest purposes like public health or archiving.
Okay.
You also have the right to object to processing of your data in specific situations. For example, if a company is using your data for direct marketing purposes, you have an absolute right to object and they must stop. You can also object to processing based on legitimate interests or public tasks, but the company can sometimes override this if they demonstrate compelling legitimate grounds.
And what about moving data?
Yes, that's the right to data portability. This allows you, in certain circumstances, to receive your personal data, the data you provided to the controller, in a structured, commonly used, and machine-readable format, like a CSV file. And you have the right to transmit that data to another service provider without hindrance from the original controller. Think of it like easily taking your entire playlist history from one music streaming service to another, or your contact list from one social media platform to a competitor.
So it makes switching easier.
Exactly. This right significantly fosters competition by making it easier for you to switch services without being locked in by your data. It empowers you to choose providers based on service quality or price, not just the inertia of leaving your data behind. These rights collectively represent a monumental shift, genuinely giving individuals greater control and transparency over their digital footprint.
That's a fantastic overview of our rights. Now, with all these robust rights and principles in place, who is the ultimate enforcer? How are organizations actually held accountable if they don't comply? This is where the Information Commissioner's Office, or ICO, steps in, right?
Yep.
And they wield significant powers under UK GDPR.
They certainly do. The sheer breadth of the ICO's powers is truly fascinating, and it ranges from relatively simple information requests all the way to imposing multi-million-pound financial penalties and even initiating criminal prosecution in some cases.
Wow.
It profoundly underscores the gravity with which data protection is now viewed in the UK. The Information Commissioner is the independent body specifically responsible for overseeing the application and enforcement of UK GDPR across the board.
And firms have to report breaches to them.
Yes, that's a critical responsibility. Firms must report any significant personal data breaches, those likely to result in a risk to individuals' rights and freedoms to the ICO without undue delay, and generally within 72 hours of becoming aware of it. This rapid reporting mechanism is absolutely essential for swift action, containment, and mitigation of harm.
Okay, so the ICO gets notified. What can they actually do then? What tools do they have?
They have a formidable arsenal of enforcement tools, as outlined clearly in our sources. For starters, they can serve information notices. These legally compel organizations to provide specific information about their data processing activities, usually within a defined time frame. It's like a formal request for information they can't ignore.
Right.
They can also issue undertakings where a company formally commits, in writing, to a particular course of action to improve its compliance practices. This often happens after a minor breach or where concerns have been raised, but it's less severe than formal enforcement.
So a formal promise to do better.
Essentially, yes. But for more serious noncompliance, they can serve enforcement notices and even stop-now notices. These legally require organizations to take specific corrective steps to comply with the law, like changing a process or deleting improperly held data, or, in urgent cases, to immediately halt certain data processing activities if they pose a significant risk to individuals.
That sounds quite powerful.
It is, and beyond reacting to problems, they can be proactive, they can conduct consensual assessments, which are basically audits carried out with the organization's cooperation to check their compliance levels.
And if they don't cooperate?
Well, if cooperation isn't forthcoming, or if the ICO has specific concerns, they can serve assessment notices, which mandate compulsory audits. They can essentially force their way in to check compliance.
Okay. And the big one, the fines.
Yes, the financial penalties. For flagrant or serious breaches of UK GDPR, the ICO can issue monetary penalty notices, imposing really substantial financial penalties. And the maximum penalty is truly eye-watering.
How much you're talking?
It can be up to 17.5 million or 4% of the offending organization's total annual worldwide turnover from the preceding financial year, whichever amount is higher.
4% of global turnover.
Yes. That demonstrates the profound financial consequences of getting data protection wrong. It's designed to make even the largest multinational corporations sit up and take notice.
That kind of penalty certainly underscores how seriously data breaches are taken now. Are there criminal sanctions too?
Yes. The ICO also has the power to prosecute criminal offenses under UK GDPR and the Data Protection Act 2018. For instance, it's a criminal offense to fail to comply with an information notice or an enforcement notice without a reasonable excuse, or to knowingly or recklessly make a false statement in response to such a notice, or to obstruct the commissioner in exercising their functions. There are also offenses related to altering or destroying information requested by the ICO.
So individuals could potentially face prosecution.
Individuals within organizations, yes, potentially, as well as the organization itself. And in the most extreme cases of non-compliance or risk, the ICO can even issue a ban, either temporary or permanent, prohibiting an organization from carrying out certain types of data processing activities altogether.
A complete stop.
A complete stop. We've certainly seen serious data breaches make headline news in recent years, highlighting the significant public and regulatory concern for robust data protection. It's really a testament to the fact that safeguarding personal data is no longer just some niche IT concern. It's a fundamental mainstream business and ethical imperative.
Absolutely. Okay, from the really intricate world of your personal data, let's transition now to another crucial aspect of your financial security: safeguarding your future, specifically your pensions. This brings us to the Pensions Regulator, or TPR, and the Pension Protection Fund, the PPF, two critical guardians of your retirement savings.
Yes, and the Pensions Regulator, TPR, is the independent body specifically responsible for the regulation of work-based or occupational pension schemes right across the UK.
So the pensions you get through your job.
Exactly. And for financial advisors, having a really solid understanding of how these schemes work and are regulated is paramount because they directly impact the retirement prospects of literally millions of individuals. TPR's core aims are meticulously designed to protect you, the pension scheme member, ensuring your hard-earned contributions are secure and the scheme is well run.
It's true. Pensions often feel like such a distant future concern, don't they? Something abstract we contribute to maybe month by month. But the pensions regulator is actively working right now in the present to ensure that future is secure for you.
That's a great way to put it.
And one of their foundational aims, which has had a massive, widespread impact across the UK in recent years, is ensuring employers enroll eligible staff into a work-based pension scheme, the process known as automatic enrollment.
Huge initiative. It's brought millions more people into pension saving, many for the first time.
Absolutely. But it's not just about getting people in, is it?
No, not at all. Beyond enrollment, TPR also aims to protect accrued pension benefits and direct pay arrangements. This means ensuring that the pension promises made to you over your working life are genuinely delivered when you retire.
So the money is actually there.
Precisely. Promoting good administration of schemes is another critical objective. Poor administration thinks inaccurate record keeping, delays in payments, inadequate funding, or even in worst cases, dishonesty and fraud by trustees can significantly undermine a pension scheme's security and your confidence in it. They also work diligently to reduce the risk of situations that could lead to claims on the Pension Protection Fund, which is that vital safety net we'll discuss shortly. They want to prevent schemes needing that bailout if possible. Ultimately, their goal is to maximize employer compliance with their duties under the Pensions Act 2008 and other relevant legislation. But, importantly, they also aim to minimize any adverse impact on sustainable employer growth. They have to strike that crucial balance between ensuring employers meet their responsibilities and not crippling viable businesses with overly burdensome regulations.
That balance must be tricky to get right.
It's incredibly challenging, yes.
And the TPR isn't just a reactive body waiting for things to go wrong, is it? It has comprehensive powers that allow it to intervene at multiple stages to protect members' interests. This really highlights the significant societal importance placed on pension security. Could you detail some of those powers for us?
Certainly. TPR's powers are quite extensive and fall into three main categories, as our sources outline. First, they focus on investigating schemes.
Finding problems early.
Exactly. This includes proactively identifying and investigating potential risks, compelling organizations and individuals involved with schemes to provide information and documents, warning trustees or managers of potential noncompliance, and actively investigating specific cases of suspected mismanagement, poor governance, or financial distress. This allows them to spot problems before they escalate into major crises that could harm members.
Okay, so they investigate. What if they find something wrong?
Well, that leads to the second category, their powers for putting things right. If a problem is identified, TPR can demand specific corrective actions. They have the authority, for instance, to recover unpaid contributions from employers, ensuring that the money earmarked for pensions actually makes it into the scheme fund.
That's critical.
Absolutely. They can issue improvement notices requiring specific actions within a set time frame. They can also disqualify trustees who are deemed unfit and proper to manage a pension scheme, directly addressing governance failures. And in cases of severe noncompliance, fraud, or providing false information, they have the power to impose significant financial penalties and even initiate criminal prosecutions.
Serious consequences.
Very serious. And third, which is particularly crucial, especially in challenging economic times, are their powers for acting against avoidance.
Avoidance. What does that mean in this context?
This is designed to prevent employers from deliberately trying to evade their pension obligations, especially if a company is in financial difficulty and might try to offload its pension liabilities or transfer valuable assets out of the business to put them beyond the reach of the pension scheme.
Trying to dodge responsibility.
Exactly. TPR has powers, often called moral hazard powers, to counteract this. They can issue contribution notices, compelling an employer, or even associated companies or individuals, to pay a specified sum towards a scheme if they've acted in a way that detrimentally affects the scheme's funding. And crucially, they can issue financial support directions, requiring financially stronger companies within a corporate group to provide financial support for an underfunded defined benefit scheme run by a weaker company in the same group.
So they can go after related companies too.
They can, yes. This ensures that even if one part of an employer group faces financial difficulty, they can't just abandon their pension responsibilities easily. It acts as a powerful deterrent against shirking duties and provides a vital layer of security for scheme members, especially in complex corporate structures.
That's a really significant range of powers for TPR. But what happens if, despite all of TPR's oversight and intervention, an employer simply cannot meet its pension obligations? Perhaps because the company goes bust, becomes insolvent. This is where the Pension Protection Fund, the PPF, steps in as that critical safety net you mentioned.
Precisely.
I mean, imagine planning your entire retirement based on a defined pension promise, only for your employer to collapse just before or even after you retire. The PPF ensures you're not left completely high and dry.
Exactly right. The PPF was established by the Pensions Act 2004 with a very clear, specific mandate to protect members of private sector defined benefit pension schemes.
Defined benefit, that's where the employer promises a specific income, right? Not defined contribution where it depends on investments.
Correct. A defined benefit DB scheme, sometimes called a final salary or career average scheme, is one where the employer promises a specific level of income in retirement, usually calculated based on factors like your salary near retirement and your length of service with the company. It's a promise from the employer. Defined contribution D schemes, which are much more common now for new employees, are different. The amount you get depends on how much is contributed by you and/or your employer and how well those investments perform. The PPF specifically protects eligible DB schemes.
Okay, so just the DB schemes.
Primarily, yes. If an employer running an eligible defined benefit scheme becomes insolvent and the scheme simply doesn't have enough assets to cover the pensions it owes, its PPF compensation levels, then the PPF steps in to take over the scheme and pay compensation to the members. It's an absolutely vital safeguard against the catastrophic loss of employees' accrued pension rights in the face of corporate failure.
And does it cover fraud, too?
Yes, that's another important function. The PPF also administers the Separate Fraud Compensation Fund, which can provide compensation for occupational pension schemes, both DB and DC, that have suffered losses due to dishonesty, essentially, where money has been misappropriated through fraud. So it provides an additional layer of financial security against criminal activity within a scheme.
Okay, so how does the PPF actually provide this critical protection? What does it mean for someone whose pension scheme ends up falling into the PPF? How much do they get?
Right. The PPF provides varying levels of compensation to members, depending on their circumstances when the scheme enters the PPF assessment period. Generally speaking, for members who are already retired and receiving their pension benefits, or are over the scheme's normal pension age, the PPF aims to provide 100% of the pension they were receiving at the time, subject to certain caps on recent increases.
So full protection if you're already retired.
Largely, yes. For members who are yet to retire, i.e., they are below the scheme's normal pension age, the compensation is typically calculated as 90% of their accrued pension benefits at the time of the employer's insolvency.
90%.
90%, but this 90% level is also subject to an overall annual cap. This cap changes each year and depends on age, but it means that very high earners might receive less than 90% of their expected pension if their entitlement exceeds the cap.
Okay, so there's a limit for higher earners who haven't retired yet.
Correct. The idea is to provide a substantial safety net, but perhaps not fully replicate extremely large pension promises. It ensures a substantial, though not always identical, portion of their expected retirement income is protected.
And how does the PPF actually fund all this? Where's the money come from? It must be a huge amount.
It is a significant undertaking. The PPF achieves this through several clever, interconnected mechanisms. Firstly, and primarily, it operates by imposing an annual levy on all eligible solvent-defined benefit schemes across the UK.
So healthy schemes pay in.
Exactly. It creates a collective insurance pool. Healthy, ongoing schemes contribute to protecting the members of schemes whose employers fail. The levy calculation is complex, based partly on the scheme's funding level and partly on the perceived risk of the sponsoring employer becoming insolvent. It's a mutual support system that underpins the entire defined benefit landscape.
Okay, the levy is key. What else?
Secondly, when a scheme enters the PPF, after an assessment period confirms it can't afford PPF compensation levels, the PPF takes on the assets of that scheme. Whatever investments or funds the scheme held are transferred to the PPF and integrated into its own substantial portfolio.
So it gets the leftover assets.
Yes. Thirdly, the PPF actively seeks the recovery of assets and debts owed to the pension scheme from the insolvent employer's estate during the insolvency proceedings. They act as a major creditor, trying to salvage as much value as possible to contribute back to the fund. And fourthly, the PPF itself works diligently to grow its own funds through prudent, long-term investment strategies. It manages a very large and diversified investment portfolio with the aim of building a sustainable reserve to meet current and future compensation claims, ensuring its long-term viability.
So it invests the money it collects and receives.
Precisely. This dynamic funding mechanism means that while the PPF provides that crucial safety net, it also, indirectly, incentivizes good governance and better funding within the entire pension sector. Why? Because schemes that are better funded and whose employers are seen as lower risk generally pay lower PPF levies.
Ah, an incentive to manage risks well.
Exactly. So its existence relies on sound contributions and prudent management across the board. It truly provides a significant level of confidence in the overall defined benefit pension system, knowing there's this substantial backstop in place should the worst happen to your employer.
Okay, that's pensions covered. Now, moving from securing your retirement to navigating the complex, sometimes quite intimidating, world of investments. Let's explore the directives and regulations that govern this space, including key players like MiFID, UCITES, and AIFMD. Quite the alphabet soup.
It can certainly seem that way, and it's important as a starting point to understand that much of the UK's robust financial services regulation actually originated from EU directives developed over many years.
Right, even post-Brexit.
Yes. Post-Brexit, these existing EU-derived provisions were meticulously onshored, which basically means they were maintained and incorporated directly into the UK statute books, or in some cases, amended slightly to suit the new UK-only regulatory landscape.
It's a lot of continuity.
A significant amount of continuity, yes. And we're still seeing ongoing evolution, of course,
Unreal.
with further changes expected from significant new UK legislation like the Financial Services and Markets Act 2023, which gives UK regulators more power to shape the rules going forward.
Okay, so even with Brexit, the foundations of UK financial regulation often trace back to these broader European frameworks. It creates a landscape that embraces both that continuity you mentioned, but also allows for future divergence and change.
Exactly. And it's probably worth quickly noting the fundamental difference between an EU directive and an EU regulation, as it helps understand how this onshoring worked.
Good point. What's the difference?
Well, think of a directive as more like a blueprint. It sets a goal or an outcome that EU member states must achieve, but it leaves it up to individual countries to create their own specific national laws to implement it. This could sometimes lead to slight variations in how it was applied country by country.
Okay, a goal to achieve.
Whereas a regulation is more like a fully built house, it's immediately and universally applicable and legally binding in all EU member states as is, without the need for additional national legislation. GDPR was a regulation, for example.
Ah, okay. Directly applicable.
Yes. So onshoring involved taking all this existing EU law, whether it originated as a directive implemented via UK law or a directly applicable regulation, and making sure it continued to function correctly as UK-only law after withdrawal. It ensured legal clarity and continuity on day one.
That makes sense. Okay, so within this landscape, a key part, especially in the modern financial world, is the Electronic Money Regulations 2011, often called 2EMD.
Yes, that's right. The second Electronic Money Directive, implemented in the UK via those 2011 regulations, this specifically governs electronic money institutions, or EMIs. And again, the UK wisely retained these regulations post-Brexit, recognizing the absolutely exploding importance of this sector.
And electronic money, or e-money, is a huge expanding area that probably many of us interact with daily, maybe without even realizing it's specifically regulated in this way.
Very likely, yeah.
So what is it exactly?
It's defined quite specifically as electronically stored monetary value, which represents a claim on the issuer, the EMI, and it's issued on receipt of funds for the primary purpose of making payment transactions.
No.
Think of popular payment apps like Revolut or Wise, maybe digital wallets where you hold balances online, perhaps platforms like PayPal to some extent, or even those prepaid debit cards you might use for online shopping or travel money.
Right, I use some of those.
These aren't traditional banks, typically, but they hold your money electronically, allow you to make payments, transfer funds, etc. Specific regulation for e-money is absolutely necessary, given its increasing use, its digital nature, and the fact it operates outside traditional banking frameworks sometimes.
So what do the regulations do?
2EMD and the UK regulations implementing it step in to ensure that even though these services operate differently, they still have robust safeguards in place for consumers. A key one is safeguarding.
Safeguarding.
Yes, EMIs are required to safeguard the funds they receive from customers. This usually means segregating your money completely from their own company operating funds, perhaps in a separate account with a traditional bank. The crucial point is, if the e-money institution itself were to go bust, your e-money should still be protected and returned to you because it's kept separate. It's not covered by the Financial Services Compensation Scheme like bank deposits, but safeguarding offers a different, vital protection.
Ah, that's really important. So my money's separate.
It should be, yes. That's a core requirement. It's crucial because these digital solutions are increasingly where we hold and transfer our digital cash day to day.
Definitely. Okay, moving on from e-money then, let's tackle the really big one, the Markets in Financial Instruments Directive, or MiFID.
Ah, MiFID, yes. Incredibly influential. This comprehensive directive and its successor MiFID II applies to firms that provide investment services related to what are broadly called tradable financial instruments.
And that covers a lot, right?
A huge amount. These include things like company shares, corporate and government bonds, units in collective investments like mutual funds or OEICs, and a whole range of complex financial derivatives like futures, options, and swaps. Basically, most things you can invest in or trade on a financial market.
Okay. So MiFID is a truly monumental piece of legislation. What's its core purpose? Why was it needed?
Well, its core purpose really is elegantly simple at heart: to ensure the buying and selling of these often complex investments is done both fairly and transparently for everyone involved, especially the end investor. Its main objectives were twofold. Firstly, to significantly increase competition within the financial services sector across Europe by creating a more harmonized set of rules, allowing firms to operate more easily across borders, the single market ID.
Like level the playing field.
Exactly. And secondly, and perhaps even more importantly from a consumer perspective, to enhance consumer protection for investors. It sets stringent requirements across key areas, including detailed rules for how firms must conduct their business when dealing with clients, the organizational requirements for the firms themselves, like having adequate systems and controls, and a very strong emphasis on market transparency.
Why is market transparency so vital?
Transparency is absolutely vital for investor confidence and for ensuring fair pricing. It means making information about prices and trading volumes available both before a trade happens, pre-trade transparency, and after it's completed, post-trade transparency. This reduces the potential for market manipulation, allows investors to see the true supply and demand, helps ensure they get a fair price, and ultimately allows them to make more informed decisions based on clear market information. MiFID aimed to create a more level playing field in terms of access to information.
Okay, that makes sense. And then came MiFID II, building on that foundation.
Yes, exactly. MiFID II, which was initially launched way back in 2010 but became fully effective across the EU and therefore the UK at the time, from January 2018, brought about truly comprehensive reforms.
Why the update? What prompted MiFID II?
Well, MiFID II was largely a direct response to the lessons learned or perhaps the shortcomings revealed by the global financial crisis of 2008.
Ah, the crisis again.
Yes. The crisis highlighted areas where the original MiFID wasn't perhaps robust enough, particularly regarding certain types of instruments like derivatives traded off exchange, market structures like dark pools, and investor protection standards. MiFID II aimed to address these issues and loopholes, strengthen the regulatory framework significantly, and further elevate investor protection in an increasingly complex, fast-moving, and interconnected global financial world.
Okay, so MiFID II fundamentally shifts the balance even further towards greater investor clarity and protection. Yeah, you mentioned it covers 8 main areas of reform in the sources.
That's right. It's incredibly broad. Firstly, conduct of business rules were substantially enhanced. This involved raising the bar for the level of protection afforded to different categories of investors, particularly retail clients, everyday individuals, versus professional clients or eligible counterparties, like large institutions. It means stricter requirements on how firms communicate with you, assess suitability, manage conflicts of interest, and execute your orders.
More protection for the average person.
Definitely. Secondly, transparency rules were significantly extended, particularly pushing for much greater pre- and post-trade transparency in non-equity investments. Think bonds, structured finance products, emission allowances, and derivatives. Previously, these markets were often much more opaque than stock markets. MiFID II aimed to shine a much brighter light on trading activity in these areas.
So more visibility across the board.
Yes. Thirdly, there were significant developments regarding market structures. This aimed to produce more comprehensive regulation of secondary trading markets, including bringing more trading onto regulated venues and addressing the growth of alternative trading systems and dark pools, private trading venues with less pre-trade transparency. The goal was to ensure fair and orderly trading across all types of platforms.
Okay. Fourth,
Organizational requirements for investment firms were bolstered. This covered everything from senior management responsibility and corporate governance to internal controls, risk management, record keeping, and outsourcing arrangements, essentially ensuring that the firms themselves are run to demonstrably high standards of competence and integrity.
like making sure the firms are solid.
Fifth, it refined the requirements specifically for commodity derivatives. These are complex financial instruments tied to the price of underlying physical commodities like oil, gas, or agricultural products. MiFID II introduced position limits and reporting requirements to try and curb excessive speculation and improve market oversight in these critical markets.
Okay. And number 6, dealing with speed.
Exactly. Sixth, it introduced specific measures for high-frequency trading, HFT, and algorithmic trading. Recognizing the sheer speed and potential market impact of automated trading strategies, MiFID II brought in rules requiring firms using these techniques to have robust testing, controls, and circuit breakers in place to prevent them from causing or amplifying market disruption. It also introduced requirements like order-to-trade ratios to discourage excessive quoting without actual trading.
Trying to tame the machines a
I
bit.
could say that, yes. Trying to ensure market integrity in that lightning-fast segment of the market. Seventh, and hugely important for investors, disclosure rules were profoundly enhanced. A key change was requiring aggregated cost disclosure.
Aggregated cost disclosure.
Yes. This means firms have to provide you with a total, explicit breakdown of all the costs and charges associated with an investment service or product, both upfront and on an ongoing basis. This includes not just the firm's own advice or service fees, but also all the underlying product charges from fund managers, etc. It gives you a much clearer, holistic picture of every single fee, charge, and commission you are paying, making it significantly easier to compare different products and providers and understand the true impact of costs on your potential returns. No more hidden fees, in theory.
That sounds like a massive improvement.
It was intended to be, yes. And eighth, and absolutely crucially for investor protection, suitability and appropriateness rules were significantly tightened.
Suitability, making sure the investment fits the person.
Precisely. When a firm provides investment advice or manages a portfolio for you, MiFID II mandates a thorough assessment of your specific knowledge and experience, your financial situation, including your ability to bear losses, and your precise investment objectives, like your goals, time horizon, and risk tolerance. This assessment must form the basis for any recommendation.
So they have to really know you.
They absolutely do. And the product recommended must be demonstrably suitable for you based on that assessment. This directly protects you by ensuring that financial products recommended truly align with your personal circumstances and needs, legally preventing you from being advised into something unsuitable just because it might pay the advisor a higher commission, for example.
Can you give an example?
Sure. Under these rules, it would be a clear breach for a financial advisor to recommend, say, a highly speculative, volatile, illiquid investment, like venture capital trust shares, to an elderly retiree on a fixed income whose primary stated objective is capital preservation and generating a low-risk income stream. The product simply wouldn't match the client's needs or risk profile. MiFID II forces the recommendations to align with your best financial interest. It also strengthened the related appropriateness test for situations where no advice is given but the firm still executes a complex transaction for you.
Okay, that makes MiFID II's impact much clearer. So, understanding these broad investment regulations, what does this all mean specifically for collective investments? You know, the various types of funds people invest in, like mutual funds or hedge funds. This brings us back to UCITS and AIFMD. You said earlier they dictate how different funds are regulated and who can invest in them.
Yes, that's the core distinction. Let's start with UCITS. That stands for Undertakings for Collective Investment in Transferable Securities. It's a bit of a mouthful, but UCITS is essentially a globally recognized brand, almost a gold standard for retail investment funds. The UCITS directive specifically regulates these retail funds, the kinds of funds typically sold to the general public and the companies that manage them.
So the funds most people might invest in via an ISA or a pension.
Exactly, those kinds of funds, yes. It provides a common, harmonized framework for investor protection and product control across many jurisdictions, not just the EU. Crucially, it established the concept of passporting.
Passporting.
Yes, this allows a UCITS-compliant fund that's authorized in one participating country, say Luxembourg or Ireland, which are huge centers for fund administration, to be marketed and sold publicly to retail investors across other participating countries with minimal additional regulatory hurdles.
So easy cross-border sales.
Relatively easy, yes. This has led to an explosion of cross-border investment opportunities for retail investors, all built on a foundation of robust consumer safeguards embedded within the UCITS rules themselves. These include strict rules about diversification, not putting all eggs in one basket, liquidity, ensuring investors can get their money out easily, permitted investments, risk management, and transparency, like producing standardized key investor information documents or KIDs. These features make UCITS funds generally considered safer and more suitable for the average retail investor.
Okay, so UCITS is for the mainstream retail market. What about AIFMD?
Right. In stark contrast to UCITS, we have the Alternative Investment Fund Managers Directive, or AIFMD. This directive regulates the managers of alternative investment funds, AIFs.
Alternative funds, like what?
AIFs cover a very broad church of funds that aren't UCITS. This includes much more complex and often higher risk investment strategies and asset classes like hedge funds, private equity funds, real estate funds, infrastructure funds, venture capital funds, commodity funds, and so on.
So not your typical high street fund.
Generally not, no. These AIFs are typically structured and marketed very differently, and importantly, they are usually sold only to professional investors.
Professional investors. Who are they?
AIFMD defines professional investors, typically large institutions like pension funds or insurance companies, large corporations, national governments, or very wealthy, sophisticated individuals who meet certain high thresholds for assets or investment experience and elect to be treated as professionals. They are presumed to have the expertise to understand the higher risks involved.
So AIFMD regulates the managers, and the funds are for sophisticated investors, not the general public.
That's the key distinction, yes. AIFMD focuses on regulating the manager, the AIFM, requiring them to be authorized, meet capital requirements, have robust risk management and valuation processes, appoint independent depositaries, custodians, and provide detailed transparency reporting to regulators and investors. It aims to manage systemic risk and provide professional investor protection, but the funds themselves are generally considered unsuitable for retail investors due to their complexity, potential illiquidity, higher fees, and often higher risk profiles.
So that distinction between UCITES, retail, and AIFMD professional is crucial for investor protection.
Absolutely crucial. It ensures that retail investors are primarily directed towards simpler, highly regulated, and generally more liquid products like UCITES funds, while sophisticated professional investors who are better equipped to assess the risks can access the more complex, potentially higher return but also higher risk, alternative investment strategies offered by AIFs.
And how did Brexit affect these? Did the UK keep both?
Yes, the UK retained the regulatory frameworks for both UCITES and AIFMD post-Brexit, converting them into UK law. So UK investors still benefit from these established standards. However, a key change was the loss of passporting rights. UK-based UCITES funds and AIFMs can no longer be automatically marketed across the EU using the passport. They now need to comply with the specific national marketing rules in each individual EU member state where they wish to sell their funds or services, which adds complexity and cost. The same applies in reverse for EU firms wanting to market into the UK.
Right, so the standards remain, but the cross-border ease is gone.
Essentially, yes.
Okay. Shifting gears now from investments to protection against the unforeseen events in life. Let's look at how your world is insured. This involves key directives impacting both life and general insurance.
Indeed. And life assurance, or life insurance as it's commonly called, serves a dual, really fundamental purpose for individuals. Firstly, it's a vital protection tool offering financial security to loved ones' dependents, family members upon one's passing, helping replace lost income or covered debts like mortgages.
The protection element.
Yes. And secondly, it frequently acts as a long-term savings or investment vehicle. Think of things like endowment policies, whole-of-life policies with investment components, or pension annuities. These contribute significantly to financial planning over decades. The directives governing this sector aim to enable citizens to access a wide range of these products across borders, historically within the EU, while ensuring high standards of legal and financial protection are consistently maintained. The framework recognizes life assurance as a significant component of the long-term savings industry.
That's a great point. Life assurance isn't just about, what happens after you're gone. It's a meticulously regulated framework that contributes significantly to long-term financial stability and personal savings throughout your life. And the Consolidated Life Directive forms the core of these rules for the UK, right? It brought together previous EU directives into one place and was retained post-Brexit.
That's correct. What's particularly insightful here, I think, is how these consolidated rules establish a consistent baseline of protection for consumers, regardless of where the insurer is based within the participating countries originally. For example, they clearly define what constitutes life assurance, including those products like annuities, which provide a guaranteed income stream in retirement, and income protection insurance, often sold alongside life cover, which pays out a regular sum if you can't work due to long-term illness or injury.
Okay.
They lay out crucial rules for cross-border services, making it easier historically for insurers authorized in one state to operate across others under the freedom of services or freedom of establishment principles. They also set out rigorous requirements for companies wanting to be authorized to sell life insurance, crucially mandating that the regulator in the insurer's home state supervises the overall financial solvency and soundness of the entire firm.
The home state regulator principle. Why is that important?
It simplifies oversight significantly. Instead of every country needing to supervise every insurer selling policies within its borders, the primary responsibility lies with the regulator where the company is headquartered. This ensures consistency and avoids regulatory duplication while still allowing host state regulators some powers over local conduct.
Right. And what about direct consumer protections in this directive?
Some key ones. A fundamental requirement, happily retained by the UK, is that policyholders must receive clear, accurate, and comprehensive information about the essential features, risks, and costs of the life assurance products offered to them before they commit to buying. This empowers you to make an informed choice based on understanding what you're actually getting.
So good pre-sale information.
Essential. And very importantly, you also have statutory cooling off rights, also known as cancellation rights. For life insurance policies, this typically allows you to cancel the policy within 30 days of receiving the policy documents without penalty and usually receiving a full refund of any premiums paid unless a claim has been made.
A 30-day window to change your mind.
Exactly. This provides a crucial safety net, a period to reconsider complex, long-term financial commitments without feeling rushed or pressured into a decision at the point of sale. It recognizes these can be significant purchases.
Okay, that covers life assurance.
Yeah.
What about general insurance? Protecting your car, your house, your travels.
Right. While life assurance deals with those long-term financial planning risks related to mortality or long-term health, general insurance, sometimes called non-life insurance, protects your assets and covers a vast range of other, often shorter-term, everyday risks. Early EU directives, specifically the second and third non-life council directives, were pivotal historically in establishing rules for cross-frontier protection in the general insurance market, similar to the life directives. They facilitated that single market for insurance services by allowing insurance companies authorized in one member state to either set up branches or provide services directly from their head office into other member states based on home state authorization and supervision.
Same principle as life insurance, then.
Broadly, yes. Authorization for general insurance is granted per specific class of insurance, for example. Class 1 is accident, Class 3 is land vehicles, motor insurance. Class 8 is fire and natural forces, property insurance. Class 18 is assistance, like travel assistance. General insurance risks are broadly classified into these various statutory categories. This historical development, again, enabled a more unified and accessible market for these essential insurance services across Europe.
Okay. And general insurance is something most of us interact with pretty regularly, isn't it? Renewing the car insurance, getting home insurance.
Absolutely. It's a very common consumer purchase.
So here's where it gets particularly interesting, I think. The Insurance Distribution Directive, or IDD. You mentioned this really modernized how all insurance is sold.
It really did. The IDD came into effect in 2018, replacing the older Insurance Mediation Directive, IMD. And what was really significant about the IDD was that it dramatically broadened its scope. The old IMD focused primarily on insurance intermediaries, brokers, agents. The IDD expanded its reach to cover all distributors of insurance products. This includes not just traditional brokers and agents, but also insurers selling directly to customers, like via their own websites or call centers, and even the hugely popular price comparison websites, PCWs.
So the comparison sites are covered now, too. That's big.
It was a massive change, yes. It was a direct response to the fundamental shifts in how consumers actually research and purchase insurance policies in the digital age. So many people now start or even complete their purchase journey online, often via PCW. The IDD aimed to ensure a level playing field and consistent consumer protection standards regardless of the channel used.
So this expansion is profoundly significant because it means that no matter how you choose to buy insurance, whether you go directly to an insurer's website, phone a call center, talk to an independent broker, or use an online comparison site, the same robust regulatory standards and consumer protections now apply across the board.
That's the intention, yes. The IDD introduced several critical reforms aimed squarely at enhancing customer experience, transparency, and trust in the insurance market. Firstly, it mandated enhanced professionalism requirements for insurance intermediaries and, importantly, relevant staff within insurance companies themselves who are involved in distribution activities.
Professionalism? Like what?
A key requirement is for individuals involved in insurance distribution to complete a minimum of 15 hours of continuous professional development (CPD) per year. This helps ensure that those advising you or selling you insurance are knowledgeable, competent, remain up to date with product changes, market developments, and regulatory requirements, and maintain high standards of ethical behavior.
Okay, 15 hours CPD. What else?
Secondly, conduct of business rules were significantly strengthened and broadened. There's an overarching principle that all insurance distributors must always act honestly, fairly, and professionally, and most importantly, act in their customers' best interests.
Best interest rule. That sounds familiar from investments.
It does, yes. It's a crucial ethical and legal standard. It means their recommendations and actions should be driven by what's suitable for you, not just what's easiest or most profitable for them. This is designed to protect you from mis-selling or being pushed towards inappropriate products.
All right.
Thirdly, mandatory disclosures were enhanced. Distributors must provide clear, timely, and comprehensive information to customers before any insurance contract is concluded. This includes information about themselves, like their regulatory status and whether they provide advice, the nature of their remuneration, how they get paid, and of course, the details of the insurance product itself. This empowers you to make informed decisions.
Okay. And wasn't there something about a standard document?
Yes, absolutely. A major practical improvement for consumers introduced by the IDD is the requirement for a standardized insurance product information document, IPID, for all non-life insurance contracts, like motor, home, travel.
A PID, what is that exactly?
The IPD is a short, standalone document written in plain language. It provides clear, concise, and easy-to-understand summary information about the product's key features, main benefits, significant exclusions or limitations, geographical limits, your obligations, the term of the contract, and how to cancel it. Crucially, it follows a standard format.
Why is the standard format so important?
Because it makes it significantly easier for you to compare different insurance policies side by side, perhaps from different insurers or found on a comparison website. You can quickly see the key differences in cover and exclusions in a consistent layout, rather than wading through pages of complex policy wording. It's designed specifically for comparability.
This sounds genuinely useful.
It really is. Fifth, the IDD introduced stricter requirements specifically for insurance-based investment products, IBIPs. These are typically life insurance products that have an investment element, where the payout depends on market performance. Given their complexity and similarity to MiFID investments, the IDD imposed additional conduct standards for selling these, including suitability or appropriateness assessments akin to MiFID, to ensure they are only sold to clients for whom they are genuinely suitable.
Okay, extra care for investment-linked insurance.
Yes. And sixth, additional information requirements were introduced for bundled products. This is where insurance is sold as part of a package alongside another non-insurance product or service.
Like buying a phone and getting insurance included.
Exactly like that. Or perhaps buying a car and the dealership offers you bundled GAP insurance or breakdown cover. The IDD requires that when insurance is offered as part of a package, the distributor must inform you whether it's possible to buy the different components separately. And if it is, they must provide an adequate description of each component, along with separate evidence of the costs and charges for each. This helps ensure transparency when you're buying a package deal, allowing you to understand exactly what insurance cover you're getting and whether it represents good value compared to buying it standalone.
So you can see if the bundle is actually a good deal.
Precisely. Finally, the IDD also aimed to simplify the process for cross-border entry for intermediaries by establishing procedures for notification between home and host state regulators, supported by a single electronic registration system run by the European insurance regulator, EIOPA. Although the UK is no longer part of this specific system post-Brexit, the underlying principle of facilitating regulated cross-border business remains relevant.
Okay, the IDD sounds like it brought some really significant changes focused on the consumer experience.
It certainly aimed to, yes. Raising standards across all distribution channels was the key goal.
So, as we've discussed, all these specific, often quite overarching regulations from data protection under GDPR to pensions with TPR and PPF, investments under MiFID, and insurance via the IDD, you might be wondering who actually ensures these rules are followed day in and day out within the financial institutions themselves.
That's a great question.
Because it's one thing to have the rules, it's another to make sure they're actually implemented on the ground. This brings us to the crucial role of the watchdogs, the various internal and external oversight groups that provide additional vital layers of protection and assurance.
Yes, and it's truly fascinating how this multi-layered system of oversight works in practice, because you're right, it's not just about the external regulators like the FCA, the PRA, or TPR imposing rules from the outside. There's also a vital network of internal and external groups whose job it is to ensure financial services institutions handle customer money, investments, and data safely, ethically, and honestly.
So multiple lines of defense.
Exactly. This multi-layered oversight is absolutely crucial for ensuring comprehensive accountability to all stakeholders, not just regulators, but also shareholders, customers like you, and even employees. These critical groups include auditors, both internal and external, trustees, especially in pensions, and the firm's own compliance officers. Each plays a distinct yet interconnected role in upholding standards.
Okay. So beyond the government regulators, there's this vital network of internal and external groups acting almost as the company's conscience, perhaps, and certainly its internal rule enforcers, ensuring compliance and ethical practice day to day. Let's start with auditors. You mentioned they often come in two distinct forms, external and internal.
That's right. Let's look at external auditors first. These are independent professional firms, think of the big accountancy firms, but also smaller ones whose members are typically part of recognized professional bodies like the Institute of Chartered Accountants in England and Wales, ICAEW, or others. Their primary statutory duty concerns the company's published financial statements, the annual report, and accounts that companies produce for shareholders and the public.
So they check the company's public figures.
Yes, they conduct a meticulous, independent audit according to strict auditing standards. Their goal is to provide an objective, independent opinion and assurance to shareholders on whether these financial reports give a true and fair view of the company's financial position and performance, whether they are free from material misstatement, significant errors, or fraud, and whether they have been prepared in accordance with relevant accounting standards like IFRS or UK GAAP and company law requirements.
And their independence is key.
Absolutely critical. The credibility of the audit depends entirely on the auditors being seen to be independent from the company management they are auditing. They're appointed by and report to the shareholders, not just the directors. Their role is to provide that unbiased external verification of financial health and accuracy, which underpins trust in the capital markets.
Okay, that's external audit. How does internal audit differ?
Internal auditors are quite different. They're usually in-house members of staff, employed directly by the organization itself, though sometimes the function is outsourced. Their task is distinctly focused inwards. Their primary audience is the company's own board, usually via an audit committee, and senior management.
So they report internally. What do they look at?
Their role is much broader than just financial statements. They are tasked with reviewing the company's entire system of risk management, assessing the design and effectiveness of its internal controls, financial and operational, and evaluating its governance processes from within. They provide invaluable, objective assurance and advice to management on how well the organization is managing its risks and achieving its objectives.
So they help the company run better and safer?
Essentially, yes. They identify potential problems, control weaknesses, inefficiencies, or compliance gaps across any area of the business, and recommend practical solutions before they potentially escalate into major issues, financial losses, or regulatory breaches. So while external auditors focus primarily on verifying the historical published financial statements for external users, internal auditors have a forward-looking role, helping management improve internal controls, operational efficiency, risk management, and overall governance effectiveness across the whole organization.
So they complement each other.
They absolutely should. Together, when working effectively, they provide a comprehensive, layered view of a company's financial health, operational integrity, and control environment, reinforcing both internal management confidence and external public trust.
Okay, auditors covered. Next, you mentioned trustees. Where do they fit in?
Trustees play a profoundly important role, particularly, though not exclusively, in the world of pensions. A trustee is legally defined as a person or an organization, like a specialist trustee company, that holds property or assets in trust for the benefit of designated beneficiaries.
Holding assets for someone else's benefit.
Precisely. This role is most commonly and critically seen in occupational pension schemes. Here, the trustees, who might be individuals appointed by the employer, representatives elected by scheme members, or independent professionals, are legally responsible for managing the scheme's investments and meticulously overseeing all the pension assets solely on behalf of the scheme members, the beneficiaries.
And you mentioned earlier they keep pension assets separate.
Yes, for occupational pension schemes, trustees play an absolutely vital role in ensuring that the pension scheme's assets are held entirely separate and legally distinct from the sponsoring employer's own business assets, usually in a separate trust fund. This separation of assets is absolutely paramount for the security of your pension. It protects the pension fund from the creditors of the employer if the employer gets into financial difficulties or even becomes insolvent. The pension fund does not belong to the employer, it belongs to the trust for the members.
That separation is critical for security, then.
Fundamental. And the legal and ethical obligation placed on trustees is incredibly high. It's known as a fiduciary duty.
Fiduciary duty, what does that mean?
It means trustees must always act solely and exclusively in the best interests of the beneficiaries, the scheme members, and other beneficiaries like dependents. They must put the members' interests above all others, including their own interests or those of the sponsoring employer. They must act prudently, impartially between different classes of beneficiaries, avoid conflicts of interest, and exercise reasonable skill and care in carrying out their duties.
Some very high standard of care and loyalty.
Extremely high. Trustees are subject to specific statutory requirements laid down in legislation, like the Trustee Act 1925, the Trustee Investments Act 1997, updating earlier law, and especially the Pensions Act 1995 and Pensions Act 2004, which set out detailed duties regarding scheme funding, investment, governance, and member communication. Think of a trustee, perhaps, like a dedicated guardian meticulously managing a child's inheritance until they come of age. Their entire focus must be on safeguarding and responsibly growing that inheritance solely for the child's future benefit, even if it means making difficult decisions or challenging others.
That's a helpful analogy.
Yeah.
Okay, auditors, trustees. Who's left? The compliance officer.
Yes, and finally, we come to a truly crucial internal role that acts as the firm's first line of defense against regulatory breaches: the compliance officer. Firms that are authorized and regulated by either the Financial Conduct Authority, FCA, or the Prudential Regulation Authority, PRA, are legally required under the regulator's rules to appoint a specific, suitably qualified and experienced individual to oversee the firm's compliance function.
So it's a mandatory role for regulated firms.
Generally, yes, especially for firms of any significant size or complexity. This individual, often holding a senior position within the firm, is responsible for overseeing the firm's entire compliance effort, ensuring rigorous adherence to all relevant legislation, like GDPR, MiFID rules, etc., the specific regulations set by the FCA and PRA, and the firm's own internal policies and procedures designed to meet those requirements.
And they often wear another hat, too, relating to financial crime.
Yes, very commonly. In many firms, the compliance officer also serves as the money laundering reporting officer, MLRO. In this capacity, they are personally responsible for the firm's compliance with anti-money laundering, AML, and counter-terrorist financing, CTF regulations. This includes implementing AML policies, ensuring staff are trained, monitoring transactions, and critically, receiving internal reports of suspicious activity from staff and deciding whether to report those suspicions externally to the National Crime Agency, NCA. It's a critical role in combating financial crime.
So the compliance officer is that dedicated professional inside the company, literally translating all these complex external regulations we've been discussing into practical day-to-day working practice and making sure they're followed.
That's an excellent summary, yes. They are the internal champions and enforcers of the rules. Their responsibilities are incredibly broad and vital. They're typically responsible for developing, maintaining, and publishing a comprehensive compliance manual, which details the firm's internal policies and procedures for meeting all its regulatory obligations.
The company rulebook for compliance.
Exactly. They also meticulously maintain all necessary compliance records, such as complaints registers, tracking customer complaints and how they're resolved, records of financial promotions, ensuring marketing materials are fair, clear, and not misleading, staff training logs, records of personal account dealing by staff, and so on. These records are essential for demonstrating compliance to the regulators.
And they deal directly with the FCA.
Yes, they typically serve as the firm's primary point of contact with the regulators. They are responsible for responding to regulatory inquiries, submitting required reports and regulatory returns, coordinating regulatory visits or inspections, and corresponding on all compliance-related matters. They are the face of the firm to the regulator on compliance issues.
Wow, a busy job.
Extremely. And crucially, they play a key role in ensuring that all staff, particularly those interacting with customers or handling client money or investments, meet the stringent regulatory requirements regarding recruitment, like fitness and propriety checks, ongoing training and competence, effective supervision, and critically adhering to ethical selling practices and conduct rules. They are involved in embedding a culture of compliance throughout the entire organization.
So their role is arguably the firm's most important internal line of defense against non-compliance.
You could certainly argue that. They are pivotal in ensuring that industry codes of conduct, regulatory requirements, and ethical standards are not just known, but are actively implemented and adhered to in practice, fostering that essential culture of compliance from the top down and bottom up.
Okay. Well, that brings us towards the end of this really comprehensive deep dive. We've certainly journeyed through the intricate and, I think we can agree, absolutely essential regulatory landscape of the UK's financial services sector today.
We really have covered a lot of ground.
We started way back with the crucial protection of your personal data under UK GDPR, understanding its profound impact in guarding against identity theft, and importantly, ensuring your rights over your own information, the right to access, correct, and even erase it.
We then explored those vital safety nets meticulously woven around your pensions. We looked at the pensions regulator actively working to protect work-based schemes and ensure good governance, and the Pension Protection Fund acting as that crucial financial safeguard in the unfortunate event of employer insolvency, ensuring your retirement savings have a layer of resilience.
Our journey then continued into the comprehensive, sometimes complex, rules governing investments under MiFID, UCITS, and AIFMD. We saw how these sophisticated directives work together to ensure fair practices, much-needed market transparency, and appropriate risk management and suitability standards for different types of investors, from the everyday individual saving for the future to the most sophisticated global institution.
And we covered the fundamental framework for insurance too, both life and general. We highlighted how directives like the Consolidated Life Directive, and particularly the Modernized Insurance Distribution Directive, IDD, aim to ensure you receive clear, fair, comparable information and appropriate advice, regardless of whether you buy your policy online, directly, or through a broker. That IPD document seems particularly useful.
Definitely. And finally, we brought it all together by looking at those essential internal and external oversight groups, the diligent external and internal auditors providing financial and operational assurance, the trusted trustees acting with fiduciary duty for beneficiaries, especially in pensions, and the critical compliance officers acting as the internal guardians of the rules, all acting as vital watchdogs, ensuring accountability, professionalism, and robust protection against fraud and mismanagement within the financial institutions themselves.
So I think the fundamental takeaway from this whole deep dive is really clear. These regulations, while undeniably detailed, sometimes technical, and intricately interconnected, are fundamentally designed with one core purpose. That is to create a secure, transparent, and fair environment for you, the consumer, whenever you engage with any financial service, be it banking, pensions, investments, or insurance.
They're the foundations of trust, really.
Exactly. They are the backbone that builds and sustains trust by ensuring accountability from firms, demanding professionalism from individuals, and providing essential protection against fraud, mis-selling, poor governance, and mismanagement.
And hopefully this deep dive has aimed to arm you, our listener, with truly actionable knowledge. It's about allowing you to understand the myriad layers of protection that should surround your financial decisions, and perhaps empowering you to ask even more informed questions next time you interact with financial services professionals or review your own arrangements.
Absolutely. It's all about empowerment through information, giving you the confidence to navigate your financial world, knowing that these safeguards, complex as they are, exist for your benefit.
Now, as we've seen throughout this extensive discussion, the regulatory landscape is definitely not static. It's a living, breathing entity, isn't it? Constantly evolving to try and keep pace with new technologies like AI and finance, emerging financial innovations like crypto assets or DeFi, and, of course, unforeseen risks or crises.
It never stands still for long.
So, with significant new UK legislation like the Financial Services and Markets Act 2023 already starting to shape the future, giving UK regulators more power to set rules tailored for the UK market, here's a final thought to leave you with. What new challenges, or perhaps even new opportunities, do you envision will demand the next wave of regulatory attention in the financial world? Will it be AI, sustainable finance, digital currency, something else entirely? And crucially, how might that next evolution impact your future financial interactions? From how you pay for things day to day, to how you invest, to how you plan for your most distant goals.